funsupermart.com.
Hello everyone, welcome to our webcast. With us today is Sam Wardwell, investment strategist from Pioneer Investment, to share with us his views on the US equity market. Hello Sam, thanks for joining us. In your view, what are the main catalysts of US equities and where is the market heading in the remainder of this year and 1 to 2 years ahead?
Looking at this year, the catalysts, I think probably the election results are the thing that people are most focused on. As we look at next year, the question of the federal budget deficit, the so-called fiscal cliff, and the debt ceiling will probably drive investor perceptions in the short run. Over the intermediate to the longer run, though, if we look out 1 or 2 years, I would say corporate profits and interest rates, and we expect interest rates to stay reasonably low and corporate profits to stay reasonably high. And so our forecast over a slightly longer time frame is that these will be tailwinds for the market.
So what are the impacts of the presidential election and fiscal cliff on the U.S. economy and market?
I think the election results matter less than people think, because whoever is the president will have to deal with the economic situation as it is. And while the two candidates have differences, the situation that they find themselves with is what will drive the limited range of choices they have. The fiscal cliff is really the biggest question. The tax increases, which are already scheduled to take place, the spending cuts, which are already scheduled to take place, clearly will be a short-term drag on the economy. But I think that people have to be aware of the longer-term benefit. If you continue to run large budget deficits, that will cause serious problems. And I think of the analogy of dieting and going to the gym. Short-term pain, but definitely worth it in the long run.
Which sectors are you most in favor of in the fourth quarter and beyond?
As we look at the U.S., rather than going too much in the small detail, I would say that we think large cap stocks are generally speaking more attractive than small cap stocks. And we are tending to favor growth over value. And when that boils down into sectors, I would say we think that the technology sector, consumer staples, and healthcare sectors look favorable to us. Relatively speaking, we are less interested in telecoms, utilities, and financials.
So how about corporate earnings and valuation of U.S. equities? Is it a good time to invest right now?
Earnings will be under some pressure in the next year. It's hard for companies to grow their earnings when the revenues are not rising. They are doing a very good job of keeping their costs under control, and that is supportive of profits. But our expectation is that profit growth will be reasonably low. To the extent that we see a bull market, and I think we will see a bull market, it's a valuation story. Valuations are really quite expensive. With a price-earnings ratio of, let's call it 13 or 14 times earnings, if you turn the earnings price, that's about a 7% yield. With a 2% dividend yield, that's quite attractive for investments. And so we think valuations are very attractive for the longer-term investor.
What are the main risks of investing in U.S. equities?
Well, there's always short-term volatility, and sentiment can change. Our belief is that that's not a major risk because sentiment is bad enough. There's enough fear in the market already that valuations are not euphoric. But in the short run, the fiscal cliff, the election news can create volatility. And so we would say, I think the biggest short-term risk investors fear is the risk that something goes wrong and they change their minds and sell. And so we would only advocate investing for people who are willing to buy on weakness and to ride through volatility. And for those people, we think that these are not risks, these are opportunities.